Well, we could probably get started. We have some folks starting to funnel in, and I can just kind of kick us off a little bit here. And as people come in, they can kind of get up to speed. So welcome to the Multifamily Investing Community Meetup. I'm Andy Bentz. I am owner of Blue Horizon Investments, a multifamily real estate investing firm. Like many of you, I'm also a passive investor. I feel continued education is the key, and that's why I've set up this meetup. And that's why I think you're all here today. So appreciate that. I feel we can learn from each other. I'm currently enrolled in David Monroe's education and mentorship program for continued learning and education. So the goal of this multifamily meetup community is to provide an opportunity for passive and active investors to increase their knowledge and build a community and understand more within the commercial real estate space. So there's no dumb questions. If you're a newbie, please ask them. Participation is appreciated. And I always say this, the quote, you are the average of the 5 people you spend the most time with. So don't leave your environment to chance. So I feel like getting together in a mastermind like this is important. So I'll do a little housekeeping. Today I have a guest with us, and it's Mano Chidambaram. And I'll let him do his, he's got a slide deck he's going to talk through. But before that, I'll do about 15 or 20 minutes of interview style conversation with him. And then he'll go through his slide deck, which will probably take 15, 20 minutes. Along the way, you can put your questions in the chat, and I'll either field them as we're going, or what I'll do is I'll leave them, if we have a lot of them, for kind of Q&A at the end. Okay, so please feel free to drop those questions in the chat. And yeah, so let me introduce Mano. So Mano Chidambaram, he is an experienced technologist turned full-time real estate entrepreneur, mentor, and investor in alternative tax-efficient investments like commercial real estate across multifamily, storage, student housing, and triple net lease industrial investments. Originally from India and an engineer by trade, Mano moved to the US in the 80s for his master's. Mano runs a private real estate investment firm, Perazul Capital, pretty cool name, I think, where he works with high net worth investors to invest in cash flowing properties across the US. They have partnered in acquisitions of over 3,000 doors and 250,000 square feet of industrial deals with worth over 300 million across Texas, Georgia, Florida, New York, Indiana, and California. Currently, Mano is actively pursuing multifamily deals in the markets of Phoenix and Tucson. So welcome, Mano. Appreciate you joining us today. So why don't we jump right in? Mano, you came over from India, and then you became an engineer in the tech space. So what kind of brought you from that tech space into commercial real estate investing?
Well, hey, once again, thanks, Andy, for inviting me, and thanks for setting up this call. And again, hi to everybody on the call. I have actually spoken to a few of you, directly. So some of what I might say might be a repetition of what I've probably talked to you about. But anyway, just to kind of recap what Andy said. Yes, I did come from India, about 30, 35 years ago as an engineer, and worked in the tech space and management consulting space for about 25 years. And about 5, 6 years ago, actually I got laid off from my last job, which was the last tech job that I did. And real estate was something that I definitely wanted to get in down the road, and down the road was kind of getting there. I was getting close to 50. My kids were getting older. They were getting middle school years. And during my prior career, I did a fair amount of traveling, both in tech as well as in consulting. So I definitely wanted to do a change in my life. And like I said, I knew I was going to do something in real estate down the road. And once I got laid off, I was trying to look for a job half-heartedly for a few months. And I decided this is the time, for me to make, some dramatic, change in my life. So, so that was my kind of a, genesis of, why I decided to kind of, get into the real estate space. And Andy, and we can, talk more about it.
Great. So did you, at that time, did you have any limited partner investments at that time?
No. So actually, when I originally started, and again, so it was all about education. I was, again, as an engineer by background, was just a lot of self-taught. So I was going for a lot of local meetups, kind of like this, online meetups, conferences, just trying to educate myself of all the different, areas within. And like everybody else, I wouldn't say everybody else, like a lot of people, I figured I'll start in single family. And so we went and picked up a couple of out-of-state single-family rentals in Indianapolis. Again, I live here in the Bay Area, so really not a great market for rental properties. And within a couple of months, and since I guess I was planning to do this, full time, within a couple of months, I realized this was not the way for me to scale, fast. So within a couple of months, I realized I got to switch to commercial, space. So that's kind of when, again, I started just going to local meetup, meeting like-minded people, and came across sponsors that were doing deals in the space, in the markets, and multifamily that I wanted to do. And then I kind of did additional research on them. I spent more than 3 to 6 months just researching the space before I actually did my first deal. So yeah, so it was probably about 6 months after I did the switch that I actually did my first LP deal as a limited partner.
Great. Okay. And so your education, did you go through a mentoring program, or did you self-learn, or did you partner with more experience and get mentorship?
Yeah. So no, I did not join any of the mentor programs. All of the education, with real estate was, predominantly self-taught. Again, since I had time on my hands, I was spending basically every day just learning this space. And once I started investing, as a limited partner in deals, with sponsors, then after a few deals, after about a year, I actually started partnering with a couple of these sponsors, and that's about where I transitioned from LP to becoming a more on the sponsorship side, where we started actually partnering with other sponsors, and that was the genesis of Perazul Capital, where I went from just investing as a limited partner, and by then I probably had invested maybe about 5 to 8 deals as a limited partner. And in about a year, once I started doing multiple deals with these sponsors, I wanted to start partnering with them in various aspects, with equity raise, with underwriting. So that's kind of how I started. It's more like hands-on training versus going through just a mentorship program. So that's kind of how I got into the space.
And so that was through those meetups, through those connections, that you started to build those relationships, and ultimately that turned into these call them mentorships with these active GPs.
Well, exactly. So it was more of a hands-on, learning, right? So where now I was involved in a lot of the underwriting, review, and deal analysis, financial analysis, maybe doing some site visits, with the group. And then we brought a lot of equity to the deal too. So the whole investor relations side, the SEC, PPMs, subscription agreements, all of those, all of the different aspects of this industry. So that's basically how I learned the space, just by doing it, along with other groups. Obviously, people, other groups who've been doing this for much longer.
Okay, awesome. And so tell us about the investments you've done. Like what categories of investments have you done?
So I started investing in multifamily, like I guess a lot of people on this call, and then I've done a lot of different multifamily deals, both as an LP as well as as part of the business, and we've done a lot of I would say student housing. I've invested in new development. I've invested in notes investing, some senior housing. So I've personally invested in a lot of different areas within the commercial real estate space. But now, over the last 4 years as a business, we're mainly focusing on the value-add multifamily space. as well as like, triple net industrial deals, because one of our, partners, they specialize in, the triple net industrial deals. So that's an area that we've been, partnering on, over the last, 3-4 years, and we've done several deals on that side too. So while we start pursuing our own deals in multifamily, we will continue partnering with other groups, on industrial deals, as well as, some larger deals that, we won't be able to do it, ourselves.
Mm-hmm. Excellent. So I know one of the pieces, and I think you're going to touch on this in your presentation, is about the team. Tell us, what does your team look like? How did you build your team? Does it evolve? Like, tell us a little bit about the people that you partner with.
Yeah, so we definitely partner with groups which have predominantly a lot of different teams. So I would like to probably table this for later, because there is a section in my presentation where I talk about all the different partners that we bring in as part of the team. It's like any other business or any other project, right? There's lots of different team members that bring different skill set to make the project a success. So yeah, so we'll talk a little bit more during the presentation.
Perfect. And tell me, have you had any deals go full circle, from acquisition to asset management to ultimately disposition of the asset and return of investments to your investors?
Yeah, so we, and again, so I got into the space about 5-6 years ago. So on my personal investment, we've exited about, I would say about 3 deals. Now there were a few deals that were supposed to have exited last year, and due to COVID, obviously got delayed to this year. So we're exiting a few more deals. Now on the business side, we've exited only on 1 deal so far. Like I said, that's been about, so we started this about 4 years ago. So we are in in about 8 to 10 deals, and we just exited on 1 of the deals so far. So not too many exits yet, because it's been only about 3-4 years, and like I said, the COVID kind of extended the timeline a little bit.
And then how long is your typical hold?
So most of the deals, again, it's projected, typical timelines are between 3 to 5 years. We always underwrite, for like 10 years for worst case scenario, but typically the life cycle for most of these deals is projected for about 3 to 5 years.
Okay. All right.
So again, the goal is if we can hit the metrics, earlier, we would like to exit earlier, so that you get your money back, and then you can reinvest in other deals, right? It's velocity of money rather than staying in the deal.
So that's a great point you bring up. So as a limited partner, as I'm thinking about those folks that are new to this real estate investing space, would you recommend, like, how do you recommend the strategy of, you invested into 1 deal, maybe you're getting cash flow from that. What would be the strategy? Would you layer in another deal? When one closes, you roll it into the next deal? Like, do you have a strategy? Can you talk to, or would you recommend a strategy?
Well, so again, the strategy, I mean, there is no one set strategies, obviously, dependent on the individual, how much of obviously equity do they have that they could invest in deals. So I mean, if you got a lot of equity that you're ready to invest in these deals, I mean, your initial goal is going to be finding the right sponsor groups, right, that you want to invest in, finding the right markets that you want to invest in, finding the right products that you want to invest in. I'll talk a little bit about that during the presentation. Once you've identified the groups that you want to invest with, then you're going to be limited by the amount of capital that you got to invest, right? Mm-hmm. Now, initially, for most people, I mean, you want to kind of prove this concept, right? I mean, if you're already familiar with this concept, yes, you're going to start investing in multiple deals at the same time. But a lot of people initially might want to invest in 1 deal, right? And you want to kind of see how this plays out. You might want to wait for some of the distributions to start flowing in, right? Now, if you have additional equity, once you get a good feel, hey, this is a legit process, this investment works, and you've done enough independent research about this whole space, you feel comfortable enough to do additional deals, then you would go ahead and do an additional deal, maybe with the same sponsor, or maybe with a different sponsor, in a different market. But for a lot of people, I would presume that until you go full cycle, get your money back, you always have this concern, well, what happens if this goes south, right? But it's like any other investment. There's no guarantees. There's risks involved in all investments. So I mean, that's a legitimate concern for a lot of investors that hey, I might want to wait for a full cycle, right? But again, that could be 3 to 5 years down the road. So it depends on, what your timeline is, where you are in your life. Now you're working full time, like, you got, some capital to invest in one deal, then you invest that. Or if you're like, closer to retirement and then you're trying to transition more into this space, then you might want to start ramping up, more of the investments, right? So there is no like, one size fits all. It's purely like, here's all the different, ways that people could invest in. And it's purely up to like, your risk, tolerance and, how quickly you want to ramp up these investments.
Great. So tell us about your best deal.
Well, again, so can't talk a whole lot about the best deal since we've exited only on one. So far that's been the best deal. And again, so this is a deal, like it's a multifamily deal. We exited just last month, and we came in at about 15+ IRR. The projections were like 16. This is in the midst of the COVID. So this was actually, we exited in 2 years because we ended up actually hitting the exit price that we had projected for the third year within the second year, right? So the partnership group had decided to like exit earlier rather than kind of hold it, because because of the COVID, there were some collection issues that were slowing down some of the distributions. But on the back end, the price was still coming in as what we had originally projected for the third year. So they decided to exit for a return profile that was close enough to the original projection, but at the same time, we could get the money back out in 2 years. So far, I would say since I've exited only on one, it's a little hard to say what my best deal is.
That's great. And that's another point I want to just stress. When you talk about this multifamily investing or any commercial investing as a limited partner, you're investing in a business plan with a person that is syndicating this deal. But the business plan, to Mano's point, is when this is the cadence we're going to go through and execute the plan. And once we hit our numbers, what we need, that's when in this case, that's when you chose to cash out and then return the investment to your investors, your passive investors, which is really great. If you can do that early and pull it in, that's fantastic. So the returns are much better than anticipated. So that is
a lot of the groups, that's typically what they will try to do. Is once you project your numbers out, if your actuals are coming in closer to your projections sooner than what you'd expected, most of the time they would probably exit sooner, because at the end of the day, the investors want the money back, right? And if the returns are better or meet the target, then you're fine. You get your money back earlier than what you're projected.
Yeah. And that deal, what was it, a multifamily deal?
Yes, it was a large multifamily deal in Atlanta.
Okay, perfect. Great. Nice job on that. Okay, so now on the flip side of that, so we all learn from failing and struggles and challenges. So tell us about a deal that didn't go well, and what happened. What did you learn from this deal, and where does it stand today?
Yeah. So again, this is more on my personal investment side. All the deals that we've done as part of the business, like I said, we've exited on one. All the other ones were still in the deal, and they're all doing fine. All of the deals are performing as planned. So far. On one of my personal deals, this is actually one of the earlier deals that I personally invested in. Maybe about 4 years ago. It was more of a development deal. It was a student housing development deal in New York State, and so that hasn't really gone so well, because this kind of went through the whole entitlement phase. They went through fine, and then this was a year before COVID hit. There were concerns with some of the construction financing. So what they had originally planned for, that that group kind of pulled out, and then they spent almost a year trying to line up other construction financing, and they were getting close to that, and then COVID kind of hit, right? So that's been kind of limping along, and they're trying to figure out alternative exit options. So that for me personally, that would be one of my not so great deals so far. Again, we haven't exited that. There's still opportunity for them to find financing and start doing the project, but they're trying to figure out other exit options where they could maybe exit the investors out, and they can bring the private equity to continue with the deal. So there are still options on the table they're looking at. But so I would probably say like that's, so what did I learn? More due diligence, right? In what you're trying to invest, and figure out like is this something that you want to do? And like I said, this is a development deal. So actually, since then I haven't done any development deals. That doesn't mean I won't invest in the future. But in the last 4 years, I have not invested in any other development deals, so far. I just kind of put a pause on that, right? That doesn't mean like development deals are bad. It's just that's something that I didn't want to do at this stage. I might want to do that, down the road.
Gotcha. Okay, what's your superpower? What is it? Is it finding deals? Is it underwriting? Is it, asset management? What is your superpower?
Well, I'm not sure about superpower, but being an engineer by background, very analytical, very hands-on. So I'm, really good in like underwriting, underwriting reviews. So I would say like, out of all those things, and I've been again over the last, about 4 or 5 years, like, working a lot with investors, raising capital. So I would probably say like, those who are, probably I'm way down in the weeds, like, all of the numbers, like, I'm very data oriented. So I look at, a lot of data and analyzing markets and analyzing deals. So I would probably say like, that would probably be my, main superpower, if you will.
Great. Okay. Well, I'm just going to browse quickly through the chat. It doesn't look like there's, yeah. So I would say you can, I'll turn it over to you. Okay. You should be able to present.
All right. Let me,
Yeah, and Mano, just a quick question. Are we going to be able to get some excerpts from the presentation, or do we have to make notes as he talks along?
I am recording this, so you can review it. I will post it on YouTube or something like that.
Thank you very much.
Yep.
Heather.
Andy, can you see my slides now?
I see it is warming up, I guess. I can't see the slides yet.
Not yet.
I see that you started screen sharing, but I cannot see your slides.
Why does it say my screen sharing is paused?
Good question. Maybe try it one more time. Oh, there you go.
Can you see it?
Yes. Yep.
Okay. And you can hear me, right?
Yep. Perfect.
Okay. Again, so let's kind of like jump into this. So we're going to talk about how to bet a multifamily deal as an LP. Just a real quick question: how many of you have either invested as an LP in any deals? So far, if you can just type in the chat, like how many deals you've invested as an LP. If you haven't invested, that's fine, totally fine. This is meant to be more of a kind of an intro framework, to how to analyze deals. So just real quick agenda. We'll talk a little bit about an overall investing strategy, like as far as risk return profiles and how commercial real estate fits in. And we'll kind of talk about the three kind of like I would call like three pillars of analyzing a deal, right? So one is the team, the other one is the market that the deal is in, and the third one is the deal itself, the business plan, the assumptions that goes into the deal, and then all three would have to kind of come together to like make an opportunity successful. Just a little bit about myself, like we already talked about this. We'll skip over this. So jumping into like investing strategy. Now, commercial real estate, just like stocks, largely fall into like 4 buckets, right? They start from core plus, value add, and opportunistic, and they kind of like go in the risk return spectrum as as kind of laid out, right? The higher risk you take, the higher the potential returns are, just like the stock market, right? So on the far left, you just kind of start off with like the core. The senior debt is basically the mortgage loan that you would get on these deals, and then as you kind of move up the risk profile, you move up to the core plus and the value add and the opportunistic, then your returns, tend to go up. And opportunistic typically would be like, like on the far right would be more of the development deals, right? So there's a lot more risk involved in development deals. Everything from entitlement, land entitlement, going through the city and the county approvals, shovel ready, doing all the construction. There's a lot more risk involved in development deals, compared to something which is a core deal, which would be more of a stabilized investment, right? So you're not doing any value add upgrades. The tenant profile is like more like A class. It's in a great location, more of new buildings, with high occupancy rates. Then your returns are going to be low, just like the stock market, right? It's more of an closer to a bond-like return characteristics. And then as you move out, like you're taking on high risk to get a potentially a better return. The value add deal is predominantly like, what we would be talking about more in this, presentation, because that's probably a lot of what a lot of the, sponsor groups do. Now, there are obviously a lot of groups, who do investments in all these different buckets, but this is one area that you would probably, run into a lot of the sponsors who are working on, in this space. So we'll talk a little bit more about that. Okay, so coming to the team again, like I said, these are some of the key characteristics of what I consider makes up a team. Partners are key to the success of any project, right? Just like any other project, there are a lot of different groups that kind of come together to make a project successful. One of the key partners in my mind would be the property manager or property management team, because property managers can make or break a deal, right? They are one of the key allies to make a deal work. Because once you get a deal under contract and then you get basically the property managers on board, they are the ones who are going to be managing the daily operation, the day-to-day operations of running this business, for the next 3 to 5 years, right? Everything to deal with tenants, maintenance, leasing. So they are a very key ally, to running the business. The other key people that kind of come into the partnership would be your mortgage broker, your insurance brokers, your SEC attorney, the real estate attorney. So these are all the different partners that kind of come to put together a sponsorship team, right? The other thing you want to look at is what is the experience of the sponsor group. Now again, when you look at the experience of the sponsor group, you want to look at the group as an overall. So the sponsors themselves, may have done several deals, together or individually. They may be just starting up. One of the things you want to look for is who are the other key players on the team. Again, talking about property managers, that'll be one of the groups you want to look at. What kind of experience do they have? Do they manage like similar properties? Are they managing smaller properties? Is it a large multinational company that manages thousands of properties across the country? Are they a local mom and pop group that is managing one or two properties? So you definitely want to look at what the experience of the property management team in managing a similar property that you're looking at potentially investing in. You want to look at what the track record of the team is. And again, going back to what we were talking about, you want to see how many deals has this group done. Have they done similar deals? Have they done similar size deals? Maybe they've done smaller multifamily deals in the past, right? Maybe they've done 10, 15, 20 unit deals. Now they're moving up to the 100, 200 unit deals. You want to kind of see like, what experience do they have in running and managing, these larger deals? Have they exited, on some of their deals? How many deals have they exited? You want to look at, what the track record is. You want to look at, what the performance, that they have done in the past. Have they met or exceeded, their, projected performance? Have they done, have they provided all their, quarterly distributions as, originally planned? Now, this COVID is a little bit of an aberration, over the last year, where a lot of the sponsors have kind of paused on, some of the distributions. Again, this depends on the market. Some markets, they were doing great. In other markets, they kind of paused, either due to lack of collections or lack of visibility of when the thing was going to end. But a lot of those things are starting to turn around, and collections are getting better. So you want to kind of look at, again, what is the track record in doing their distributions. The fourth thing you want to look at is the communication or the lack of, lack thereof. You want to make sure that the sponsor team is communicating with you from from the beginning till the end, from the initial point of contact with the team. How good is the communication? Are they responding to all your questions? Either via email or through phone calls. Are they sending you regular updates on what is going on with the deal right through the process? Because a lot of these deals, like from the time they put it under contract, it could take 60 days till it closes. And so you as an investor could be coming in day 15. So what happens over the next 45 days? Are they giving you regular updates on what is going on with the process? So you want to make sure that you're getting constant communication about what is going on with the deal. And then once you close the deal, obviously, you want to make sure that you're getting regular monthly updates, quarterly updates, financial updates about P&L, balance sheet. You want to make sure that they're providing you enough, communication about the deal on an ongoing basis. Transparency. So you want to make sure, this is one of the things for me personally, is you want to make sure that the group is transparent, with a lot of the information, regarding, what is the fee structure, for the partnership. How is the deal structured? Who are all the different, key partners that is coming together to put this deal together? Is a lot of this information, is it called out in the investment summary? Some of the information may not necessarily be called out in the investment summary, which is what you as an investor might initially look at. But some of these could be called out in the PPM, which is more of the legal document that you would get once you, showed interest in getting into the deal. But you want to make sure that, there is no information that is being hidden. Because again, if you suspect there's something, being hidden, then you're starting to wonder, what else is, not being shown to you. So you want to make sure that, all these key pieces of information is out there in the open for you to look at as an investor and ask questions about it. And lastly, this is again personally for me, and your risk tolerance could be higher, but I would like to work with conservative operators, sponsors, as both as an LP as well as a business partner. So conservative, as far as one of the key things you want to make sure is preservation of capital should be #1 priority, right, for any group. The returns are great, but at the end of the day, you want to make sure that the capital is preserved. You don't want to lose the original investment. So that should kind of come through in all of their communications. You want to make sure that they're not very aggressive in a lot of the assumptions, and we'll talk about a little bit about the assumptions that goes into the in projecting the deals. But you want to make sure that they are conservatively projecting returns, they're conservatively projecting rent growth, and they're not taking undue risks in putting a deal together and projecting crazy returns that they may not necessarily be able to achieve at the end. So conservative approach for the running the business would be a great thing.
Mano, I'll just throw in a question here too on this slide. Debbie asked, where would you find the track record? Where is that available for that particular sponsor?
So good question. So again, a lot of the sponsors, depending on how much a track record they have, it might be on the website. If not, it should definitely be included as part of the investment summary. Investment summary, for people who are not familiar, will basically be the initial document that you would get, from the group about a deal, right? So once you've shown interest that, hey, you want to pursue deals with the group, you will get in, as part of the investor database. And then when they have a deal, they will actually send out an investment summary. It could be a PowerPoint slide, it could be, a PDF document. But that is basically the document that will talk about the overall deal, the team, the returns. So a lot of the sponsors, if they have a good track record, that'll be one place that they would typically include that in. Because again, it's, if you got a good track record, that is something that you want to talk about, to help investors decide whether they want to invest with you or not.
Great. Another question. If, so a lot of times investors, and maybe you'll touch on this, limited investors like to know that their syndicator has skin in the game. And how do you vet that out from
so Andy, would you mind kind of tabling some of these questions, because I am going to touch on a lot of these
Perfect.
possible earlier questions. So if you can just kind of hold off on some of these questions towards the end, and then we'll try to get to that. Just Perfect. We already have 4:40. I want to make sure that I can get through the slides.
Perfect.
Okay, so if you can just kind of start gathering these questions, then we will try to answer as much as we can at the end. If not, after the call, I will respond to all of these questions and maybe put together like a FAQ, kind of a document that people can go back and, refer to later.
Perfect. Thank you.
All right. So moving right along. So besides the theme, the other, key pillar is the markets. How do you decide, like, which market, to invest in? So you want to look for like, strong growth markets, with, strong economic fundamentals, right? Things like population growth. Obviously, like, people need apartments to live in, and you want to see, like, where people are moving to. And we'll talk a little bit about, some of these topics in the following slide. You want to look at, where the jobs are, where are the companies moving? Where are they setting up shop? Where is the job growth? So, as jobs go, that's where people are going to be moving, and people are moving, they need places to live. So you want to look at job growth as well as, sector diversity, right? So it's not just jobs, what sectors are they, across? And we'll, again, talk a little bit about that. You want to look for markets where there's, strong rent growth. Are the rents, stagnant, or is it declining? Or is it like, is it growing? And the population, the occupancy and the rent growth kind of go hand in hand. And, again, we'll touch a little bit more about this. The other factor to consider is, what is the housing affordability in this market, right? How expensive is it to buy a home? Because at the end of the day, there is a group of people, who might want to, like, become homeowners at some point, right? But they may not be able to afford a home at this point in time because it's too expensive. So that's, a big, portion of the people who rent, homes. And then there's another group of people who are just lifetime, renters, right? They are always going to be renting, and they would never, migrate to a home ownership for various reasons. Either they couldn't afford to get there, or they don't want to do that, whatever the reason might be. So the affordability of, housing is another key factor in determining, like, which markets, are good places to rent. And then lastly, like, supply, right? What is the construction, pipeline, in these markets, how much of, product is coming online. So you want to look at, like, supply, because at the end of the day, like, supply demand drives, occupancy, supply demand drives, rent. So you want to kind of look at, supply too. So on population growth, again, these are some, maps and data from Yardi Matrix. Now, oh, by the way, so a lot of the charts and data that I'm, showing out there, this is all publicly available, right? So none of this is like, paid subscription service. All of this is stuff that you can Google, you can access it on your own. And a lot of this data typically will be provided in these investment summaries too. As, sponsors that send out data, a lot of the groups will include, data like what I'm trying to show, in these slides. So again, back to population, as you can see on the map on the, top right, you can see, like, the Sunbelt, markets, right? These are the growth markets, where a lot of the, people play. A lot of the investors are investing there, and a lot of the sponsors are doing deals in these markets. Arizona, Texas, New Mexico, Florida, Georgia, all the way up to, like, the Carolinas, right? So there is a lot of, people moving in these areas, even before COVID, happened. And that trend just got, accelerated, with COVID. A lot more people, as you can see on the bottom left chart, are moving, from the coast, right? From California, people are moving to Colorado, Arizona, Texas, and from the East Coast, they're moving to the Carolinas, Florida. And as you can see in the chart on the top right, you can see the growth, percent. Arizona grew by 1.8%, Texas, 1.3%. And again, apologize for the sharpness in that, in the graphics. But so these are, some of the states that you want to be looking at. Obviously, as you can see in California, not a great place to be, as an investor, right? It is just, way too expensive. And, there is obviously a lot of people moving out of California. The other, factor that we talked about a little bit is job growth. Again, one of the things I want to point out is, like, I'm just using, like, Tucson and maybe Phoenix in the next slides, as an example. That doesn't mean these are the only markets. This is just an example. These are some of the markets that we are currently focusing on. So, I'm kind of using that as an example. There are obviously a lot of great markets, out there to invest. So with regard to job growth, again, you want to be, looking at what are the markets, where jobs are getting created, right? And, how are they, growing through time? And the other thing you want to kind of, keep an eye on too is, you want to make sure that the job diversity across sectors, as you can see on the bottom right, you want to have relatively a good mix of sectors, with the job growth, because some of the, markets, things like Orlando, which was predominantly in the entertainment sector, took a big hit, during COVID. Las Vegas is the other, market that took a big hit, and you'll see that in the next slide, where they are more predominantly in one sector or the other. So you kind of want to look for markets that has a pretty good diverse job growth across different sectors. Rent growth is a key factor in a lot of these deals, because rent growth drives income, and income drives NOI, which will be net operating income, and that helps with determining what the cash flow is going to be on the deal, and the exit price for what the deal is going to end up at. So rent growth is a very key factor in putting a lot of these deals together. And on the top left, you can see some of the bigger markets. And again, this is the data from Yardi Matrix. This is the latest data that they just came out with last month. You can see some of the phenomenal year-over-year growth in some of these markets, right? And some of these are perennial favorites. They show up in the top 5, top 10 in the last few years. Sacramento, Vegas, Inland Empire, and this is in California, Phoenix, Atlanta, Raleigh. So they always end up in in the top markets, because again, the jobs are going there, and then the rents go up, because at the end of the day, it comes down to supply and demand. So I've just kind of highlighted Phoenix, just to kind of show some of the numbers. So you want to look at the rent growth, what's happened in the past year, and the other thing you want to kind of keep an eye on is what is the forecast, for the rent growth, right? Like again, I'll use Phoenix as an example. Last year it grew, almost 6.9%, and the experts are projecting that it is going to be growing at another 4.3%, by year end this year, and they have future projections, for the following years too. So that's a pretty healthy rent growth. I mean, the perennial favorite, Dallas, as you can see, Dallas is always one of the top markets, for the last decade. And it will continue to be a great market to invest in. But you can see during the COVID years, it grew by 1.7%, which is not bad, for COVID. As you can see in Orlando, it was a drop. But Dallas is projected to grow at 3.3%. Again, very healthy rent growth. You can see the job growth column again during the normal years, you will see normal numbers. This is again due to the COVID. You can see a lot of negative numbers. But a lot of these markets, they are coming back to pre-pandemic levels. The coastal markets, the primary markets like New York, San Francisco, LA, they are, they've taken a beating, and it's going to take several years, for them to kind of turn around. But a lot of the secondary and tertiary markets are, starting to turn around, and a lot of these markets are come back to pre-pandemic levels. So on the bottom right, this is more of some of the tertiary markets, and again, I've kind of highlighted Tucson. That's one of the markets we are looking at, because there's a lot of opportunities in a lot of these tertiary markets. So it is not just the secondary markets, like the bigger MSAs like Phoenix and Dallas, where a lot of the activity is. A lot of great tertiary markets, like the Central Valley in California. There's the North Carolina Triad, Tucson, Albuquerque, Reno. So these are all great markets, and as you can see, the rent growth in these tertiary markets sometimes, they far exceed some of the other, bigger markets, close to it. So you kind of want to look at the rent growth, and you want to the bottom left, I just should kind of show some of the historical rent growth in Phoenix. As you can see, Phoenix has been a great market, in the past, and it's projected to continue being a good market, going forward. Here's just another look at the markets where across rent and occupancy, and again, as occupancy goes up by default, the rents go up. It's just a supply demand call on this. As you can see, in all the highlighted primary markets in blue, San Francisco, LA, New York, it's on the bottom left quadrant, where the occupancy has dropped dramatically. And so has the rents, because again, as people are moving out, the rents are going to drop, supply and demand. And you can see on the top right, some of the great, markets that we just talked about in the prior slide. same names, kind of show up there. Now, once you've identified, a good market to potentially invest in, now there's this thing called sub-markets. Now, obviously, a large MSA like a Phoenix or Tucson or Dallas, you can't look at it as one big segment. So within that, there could be lots of different sub-markets within that. And sub-market basically just helps identify smaller trends within that larger market. And here is an example again of Tucson, one of the markets that we are actively pursuing. On the top right, this is actually a Google Map tool that we kind of put together based on some of the data that shown at the bottom, right? So this is all public data that is available that you can look at all the different submarkets within Tucson, how each one of these submarkets are doing as far as vacancy rates or as far as rent growth. And as you can see, within the submarket, there are some markets. For instance, this is again as of I believe this is as of last month. You can see that University, which is University of Arizona, is in Tucson. The vacancy rate is 7.56, right there, and that is very high. And obviously, as colleges are getting back to in person, that is going to drop. But you can see other market, other submarkets are at 3%, 3.1% vacancy rate. Same thing with the rent growth. You see some of these submarkets have phenomenal rent growth of 9-10%. Now that may not necessarily be sustainable going forward, but this is just basically what's happened in the past. So again, this is kind of going back to we'll talk in the next slide about being conservative in your projections. You kind of want to look at historical data to guide in your projections. But at the end of the day, you want to make sure that you're conservative in your projections. You don't want to take a 10% historical rent growth and project 10% rent growth, because that is that would be crazy. So that's something to kind of keep in mind. But this Google Maps on top, we have all the data on the back end. So when we look at deals where we are analyzing the deals, just by putting the address, I can kind of see hey, which submarket does it fall in? Is it is it a growing submarket as far as rent growth or vacancy rates? So it's a little easy for us to determine hey, are we going to look at analyzing this further, or are we going to pass on these on this deal? So it's really good tool that we use. Now moving on to just the the deal itself. At a high level, here are some of the things that you want to look at. The business plan. What is again? We talked a little bit about the whole period. Most of these deals. Again, now we're talking a little bit more about the value add deals. A lot of these deals, typical timelines are about 3 to 5 year turnaround. Again, most of the people would project for 10-year hold in case financial collapse happens, what happened in 08 or COVID happened, right? You might end up holding it for a little longer, but typical timelines would be 3 to 5 years. So you kind of want to look at hey, is this within your time horizon for your investment? Is the acquisition below replacement cost? So again, these are all data that typically will be provided in the investment summary, and if it is not, these are some of the things that you might want to ask for, and hopefully they can provide. Because at the end of the day, with a value add deal, we're taking an existing property, fixing it up, raising rents, holding it for 3 to 5 years and turning around and selling it for hopefully a better price. When you're acquiring the property, you want to hopefully acquire it for below the cost of building a new building, right? I mean, at the end of the day, if somebody can build a building that are cheaper than what you're going to acquire, it doesn't make any financial sense. So that's something that you kind of want to look at. You want to see how many classic units are left in this building to be upgraded, right? Classic basically are the unrehabbed, unrenovated units. So let's say in a 200 unit property, how many units, what percent of the property is still classic units, hasn't been renovated? Because those are the units that you're possibly going to buy the property, fix it, and then turn around and sell. You want to look at in this deal what kind of renovations are they planning to do as a part of the business plan? Is it just a light to medium rehab, or is it a complete repositioning, which is basically gutting it and doing a heavy lift in this deal, where you're putting $10,000-$15,000 per unit to completely reposition the deal, maybe from a C-class property to a B-class property, versus a light to medium rehab could be a little bit of touch-up paint. You might fix the countertop, or you might fix the cabinets. maybe you're putting like, maybe $3,000 to $7,000 per unit, to fix the property. So you want to understand, like, again, what kind of a deal is this? Because again, the heavier the lift, the greater the potential risk, because at the end of the day, we are hoping to spend this money to hopefully raise rents. So you want to make sure that, like, where you are in the business cycle, does it make sense? You want to invest in this deal or not? And at the bottom, I'm just kind of listing some of the value add strategies that, typically sponsors do. Like I said, upgrading interiors and raising rents is one of the predominant ways, of driving value in these deals. The other thing could be, improving just resident profile. Like I said, again, it could be maybe in this neighborhood, like, the demographic is changing, gentrification is happening, and the resident profile is changing. So you might want to, like, work on changing the resident profile as, tenants, move out. You might want to find like a bit different profile of tenants, to put back in their place, and hopefully, like, higher rents. You might work on upgrading the common area amenities, things like the pool, is there a cabana? You might want to fix the leasing office. Now these are upgrades that is more for curb appeal. It may not necessarily bring direct, increased rents, but at the end of the day, like, you want people driving by to come into your property, right? So you might spend money on landscaping, on some external painting. So these are other things that, typically groups and sponsors might work on. And then lastly, it's improving operational efficiencies, things like, working on payroll, maybe the existing property didn't manage mom and pop. You might bring professional, third-party professional, management, to manage the property, and you can save on payroll costs or your marketing costs. You can work on, cutting down on some of the contract service costs because you have economies of scale. You can negotiate better pricing, with the vendors, compared to maybe a small, mom and pop shop. So at the end of the day, the goal is to raise NOI, which is net operating income, by either increasing rents or decreasing expenses. At the end of the day, that's, income minus expenses, net operating income, and the goal is to drive NOI growth. So here are some, key assumptions that goes into underwriting. Underwriting is basically the projections of income, expense, lines, various income expense lines, the cash flow. So underwriting is the process of, putting all these numbers together. And here are some key assumptions. Again, this is not all of it, but I just want to kind of, like, touch upon some of the key assumptions. The first thing would be, like, like stabilized rents. So the goal is, again, buy the property, currently fix the property up and hopefully raise rents. So let's say the current one bedroom is renting for $650 a unit, and you put in $5,000 per unit to fix the property, and you figure that you could rent it for $700 a unit or $725. Now, how do you come up with that number? So that is based on comparable, analysis, right? So basically, you want to look at, all comparable properties that are in similar vintage. Vintage is basically the year of build. So if your property is built at 1970s, you want to kind of look at properties that is kind of built around the 70s and 80s. You don't want to look at a property that is built in the 2000s. You want to look at similar class property. Again, this is, whether it's a C or a B class, you want to compare, apples to apples, right? You don't want to be comparing a C class property to an A class property. You want to look at the location. You want to look at the location of your property. And again, you want to look at, other properties with similar location. You may not find exact location, but, similar locations. And you want to find, like property that are close to your property. Again, within, a couple of miles from your property, depending on, the size of the city or the MSA, you might have a lot of properties, within that 1 to 2 miles, that fits your profile. They should be of similar size. You don't want to be comparing a 50-unit property to a 250-unit property because the numbers and metrics are, like, completely different. And lastly, you want to look at property that has very similar amenities, right? So if you're going to be upgrading to stainless steel appliance, you want to look at other properties that has stainless steel appliance, so that when you find the rents that they're renting their properties or their, one-bedroom apartments for, then that kind of gives you a good benchmark that, hey, if they're renting for $700, then there's a good chance that your property will rent for $700. So stabilized rents is a key factor. The other thing you want to look at is the rent growth, and we talked about it in the earlier slide, right? So you want to look at, market projections, for your market and your sub-market, and you want to use rent growth that is hopefully in line or, to be on the conservative side below what the projections are. So if somebody's projecting, 5% growth, for Phoenix, we want to project at maybe 3.5%, 4%. You want to have a little bit of a buffer in there because again, at the end of the day, all these numbers are projections, right? So you want to make sure that you're on the conservative side and not, project 6% when the market projections are 5%. Vacancy and economic vacancy. So vacancy is another, big factor in your income line. So, most of the property, as you can imagine, there will be like always vacancy. The larger the unit, there will be a lot of vacancies, in the property. And so you want to account for that, right? So you don't want to do your projection based on 100% occupied. Because if you project at 100% occupied and then once you get a vacancy, then all your projections is out the door. So you want to project conservatively. You want to look at again market projections for vacancy, and you want to add a little bit of buffer. So if market projections are 5% vacancy, you want to project at 6 or 7% vacancy, just to have a little bit more buffer, in your projections. It's a little hard to account for things like COVID when a lot of these projections were, obviously out the door because, all of a sudden, the entire economy shut down. But we're talking more like in normal markets. The other thing you want to look for is something called economic occupancy. So economic occupancy includes, the things like, bad debt, concessions. There would be a lot of properties that might give, concessions, for people to move in, hey, 1 month rent, free, or, it might be 2 months rent free. So at the end of the day, you're not getting income. There's the apartment is occupied, but there is no rent coming in. So you want to account, for the lost revenue, in your projections. Then you want to look at, your all the expense lines, things like property management, your property tax, insurance, marketing, administrative, G&A. So you want to look at all those lines, the projection for those expense lines. And what we like, to look for is the total expense line should be somewhere around the 50 to 55% of EGR, which is effective, gross revenue. So that way you're being pretty conservative. So if hopefully your actuals are coming in lower than this, maybe like 40, 45%, then you've got a little bit of a headroom. But we want to make sure that this is in almost all the deals that I personally invested in and all of the deals that, we partnered on. We like to see expenses, total expenses somewhere in the, 50 to 55% in the projections, right? So some of the things you want to kind of keep an eye out for in these expense lines is property tax line. So the normal expenses potentially will be projected to grow at 2 to 2.5%, per year, which is more of the industry norm. One of the things that sometimes, trip up, some of the groups is they don't necessarily account properly for the property tax. In a lot of the states, the property tax gets reset, upon sale, and in places like Texas. Does not happen in Arizona, but in a lot of states, the property tax dramatically jumps. For the current year, property tax could be 500,000, and upon sale, the property tax could reset to 700,000. Because obviously it's based on the higher sale price compared to what the previous owner was paying. So if you don't account for that, your projections then are going to be completely irrelevant at that point because you haven't accounted for one of the biggest item in your expense line. So you definitely want to kind of keep an eye for that. And property taxes tend to grow at a higher rate than your normal expense line. So property taxes tend to grow 4 to 5%. Or even 6% in some, some states and some counties, compared to the other expense lines growing at, 2 to 3%. So you want to kind of make sure that you account for that. And lastly, the exit cap or cap rate. Hopefully, people are familiar with what a cap rate is, but exit cap is a key factor that determines what your exit price is going to be upon sale. Because the exit price is basically just a real quick calculation would be the NOI divided by the exit cap would give you the exit price. So NOI we talked about is basically income minus expense. So if the exit cap is incorrect, then your exit projection for the exit price is going to be incorrect. So what we like to see in a lot of the deals that we've invested in, actually in almost all the deals, is they want to account for a cap rate expansion of about 2% or 10 basis points, which basically means, let's say, for instance, the cap rate, in Phoenix is 5%. When we buy, that's the market cap rate, right now for stabilized properties, for what we're buying. Then you want to see for the 5-year projection, you want to see a growth of 0.1% every year. So when they project the exit cap in 5 years, you want to see the exit cap of 5.5%, in their projections, so that you are kind of like taking into account potential interest rate growth. Now cap rates not directly correlated to interest rates, but there is a correlation to the interest rates. They don't necessarily move lockstep, but in general they kind of go along with the interest rate. So nobody knows what the interest rate is going to be in the future, but you want to kind of account for growing interest rates, because if the cap rate goes up, the property, the value goes down. So you want to make sure that you account for a growth in cap rate. And then if the cap rate compresses, which is what is basically happening in a lot of the markets where the cap rate goes down, well, then you get a lot bigger upside than what you're projected for. But you want to make sure that you're conservative in the projections. So here are some financing assumptions, and I'll kind of at 5, so I'll kind of breeze through some of these. You want to look at what kind of a loan type are they getting? Is it a bridge loan? Is it an agency loan? Or is it a bank loan? Is it a recourse or a non-recourse? A recourse loan is basically where the sponsors are signing personal guarantees, like your home loan. And a non-recourse is basically where it is, you're not signing a personal guarantee. They do have something called a bad boy carve-out, where they can come after you for, misrepresentation or fraud or other things. But in general, they can't come after you, for any default, on the property. Like I said, there are exclusions, to that rule. This is a key thing that you want to kind of keep an eye on. Is there a preferred equity in the capital stack? Typically you'll find the mortgage lender, and then you will have equity, which is basically all the limited partners, in the deal. So of late, I'm starting to see there are deals coming in with, there is a preferred equity, partner that is in between the mortgage lender and the equity, common equity partners, like limited partners. They get a higher preference, when the distribution starts coming in. So you kind of want to keep a eye on it. You want to see LTV typically around less than 75%. There are obviously deals with a loan to value 80%, but a lot of the deals, again, you want to be a little more conservative, in your financing, so that again you have a little bit more red room, in case the deal goes sideways. And you want to see is it a fixed rate or a floating rate? If there's a floating rate, you want to look for something called rate caps. Basically, it's an insurance that you buy on the rate. If the rate were to go up beyond X, then they basically cap it. You pay for that insurance up front, but they cap it, so you are kind of protected on the upside, right? The rate were to go up. So that's something to kind of keep an eye on. Are there prepayment penalties in the loan? Unlike residential loans, a lot of the commercial loans, there are huge prepayment penalties, for getting out of the loan earlier than what you originally planned for. And some of these loans, on the larger deals, the $5-10 million loans, the prepayment penalty could be a couple of $1 million. So it's a lot of money that that if you sign a loan for a 5-year loan or a 7-year loan and you want to get out in 3 years, there would be a huge prepayment penalty for you to get out. So you want to kind of weigh the options of either prepaying the prepayment penalties, or you want to go for a variable rate, right? Which is the one that we just talked about. So you want to kind of keep an eye out for prepayment penalties. You want to look at this thing called debt service coverage ratio, which is basically the ratio between the amount of income that is left over after paying all the expenses, how much of that is there to cover the basic debt payment. The banks look at, the lenders look at this as a key metric that they look at. And they want to make sure that you got a 25% buffer, about over and above the mortgage payment, so that you have enough, after you pay all the expenses, from your rent and your income, you want to make sure that there's a 25% buffer or more to account for, all the other, variability that can come in, in the incomes, stream. And then lastly, you want to look at, whether they are, projecting or modeling a refinance and return of capital scenario in their projections. A lot of the times, since the underwriting is done for 5 years, If if the value of the property, the NOI growth is, so high that the value of the property, goes up in tandem, a lot of the sponsors, will try to refinance the property in maybe 2 to 3 years and get some capital out, and then, return back some of the capital back to the investors. Or they could be in a bridge loan, for the first 1 or 2 years, which is more of a short-term loan, during the rehab phase of the project, that they might want to refinance into a permanent, agency loan, which is Fannie and Freddie loans. So they might do that in the second or the third year. And again, so they might pull some money out, hopefully the property value has gone up after your rehab, and that they might, send some of that money back to the investors. So you kind of want to look at, are they including that in the projections? So this is going back to Andy, one of the questions that you were asking earlier on, what I'm calling it aligned interests, right? So you want to see, are the interests of the sponsor team aligned with the interests, of the limited partners, right? Which is basically everybody on the call. So you want to make sure that, they have aligned interests in different areas. So we'll talk about, fees, first. So like any project, any business, there are fees that are built into the project. And one of the key ones you would see is something called an acquisition fee. So there is a ton of work that gets done prior to you even seeing the deal, right? So all the stuff that I talked about, from market research, looking at deals, literally groups look at hundreds of deals before they get one deal, right, under contract. There is a lot of site visits, there's a lot of due diligence that is done up front. So there's a lot of work that is done up front. And this fee is basically for, for all of that work, done, and for basically getting the deal and presenting to the investors. And typically you would see acquisition fee somewhere in the 1 to 2%, range of the purchase price. And the fees will drop as the purchase price, starts going up, right? So once you start getting into the 15, 20 million and above, purchase price, then you would see the acquisition fee going more towards the 1.5 to 1%. When you're in a much larger deal, the 30, $40 million deals, typically you would see fees in the 1% range. The other fee you would normally see is something called a loan guarantor fee. And again, like I talked about earlier on, when these deals are put together, there are, the sponsors, or there could be other key principals that would actually sign on the loan. And whether if it's a recourse loan, they are taking personal guarantee on the loan, or if it's a non-recourse loan, they can still come after the sponsors. Basically, they're putting up their balance sheet, because at the end of the day, a lot of the lenders are looking for the sponsor team to have enough balance sheet or net worth equal to the size of the loan. So they have to show proof, for getting this loan. So this is basically to compensate for putting up the balance sheet. So it's typically about 1% of the loan amount. The other fee you would see is the asset management fee. So the asset management is basically the fee to manage this business once we acquire the property for the next 3 to 5 years. So typically it's about 2%, of the collected rents. That is typically the fee. Then there are a couple of other fees, which is more like optional. You might find some disposition fee on the back end, upon sale. You might find some refinance fee, but those typically are a little more rare and optional. But the first three fees are more of the common fees that you would see in a lot of the deals. This is, more towards, the skin in the game, right? So what, how much of money is a sponsor investing in this deal? Typically, you will see sponsors go invest somewhere in the 5 to 10%, of the total raise amount. So if they're raising 5 million, they might put somewhere in the 250 to 500. Now, that said, now you don't want to get too hung up on this, this percent, because there is a lot of sweat equity that is put in by the sponsor team. There is a ton of work that is done, and a lot of the sponsors do this for a living. This is the full-time job, right? So they are going to be managing this and running this as a business. And so so they're not going to be putting a ton of money into the deal. That this is basically their livelihood, right? And again, if there are sponsors who do a lot of deals in a year, they might do 3-5 deals a year. So they can be possibly putting 5-10% in every deal that they do. So you kind of want to take that into account to see, how much of money, sponsors are putting. But at the end of the day, they will always put some money into the deal. So this is the other, key metric that should be used in assessing deals, right? So how is the profit split? And you will hear the term called waterfall. Basically, this is how the money is split up, between the sponsorship group as well as the limited partners, and how the money flows, from the cash flow during the whole period, as well as upon sale on the back end, the money. How is the profit split up? So there's two big models that you would see in the industry. One is called the European model, and the other one is called the American model. We'll talk about in a second. Even though it's called the European model, both these models are widely used across the world, right? So for some reason, they call the European and the American model. The European model is more common than you would see in a lot more deals, where typically you would see something called a preferred return or PREF, where it is not a guaranteed return, but it is a preferred return, which basically means when the project starts making money from cash flows, right? When the money starts coming in after you paid all the expense lines, the first 7% to 10%, let's use 8%, which is more of the industry norm, 8% pref. The first 8% of the return will come to the limited partners. Nothing goes to the sponsors, right? The entire 8% comes to the limited partners. So during the whole period, as you're doing rehab, your cash flow might be lower than the pref, and then you start building up, the cash flow as you renovate and rent the property. So typically the first X%, in this case, let's say 8%, will come to that's basically what a preferred return is. It is not an guaranteed return, but it is the first, X% comes to the LP. Only then the sponsor is promoted after all the capital is returned, back to the investors. So once a preferred return is, made to the LP, then they start returning the capital. This typically happens on the back end upon sale, right? Once we sell the property, the remaining spoils, all the capital your preferred return is made up to the 8%. All your capital is returned, 100% of the capital is returned. Only the leftover money then is split up between the sponsors and the LP team, according to whatever the predefined splits are. It could be an 80-20, it could be a 70-30, 80% obviously to the LPs and 20% to the sponsors, all the way to 50-50. Or it could be a combination of all three, right? And it could be anywhere in between. Because there would be, it could be a multi-tiered waterfall where they might start off at an 80-20 split, and up to the, when 8% of the IRR, you'll get, all 8% to the LPs. 8 to 12%, it might be an 80-20 split. Once you get 12%, it might be a 70-30 split. And once you get to 18%, it might be a 50-50 split. Basically, to incentivize, if it's a home run, deal, it incentivizes the sponsor team for a great job, done on the deal. So it could be any combination of these, right? So this is more investor friendly, as you can see, because sponsors don't get to split in the profits until you make a preferred return, until you've gotten all your capital back. The other model is more the American model. Again, it's used all around the world, and it's less common. And where typically you don't see a pref, the sponsor is promoted, or basically he's compensated before returning of your capital. So right through the whole period, as cash flow starts coming in and, there's leftover cash flow to be distributed, they will participate in the split, similar splits, right? It could be an 80-20 split. So basically you will get LPs get 80% of the cash flow, and the sponsors will get 20% of the cash flow, right from day one, right? As money starts coming in, all the way to, to the end, or it could be any combination of, these waterflow. And as you can tell, obviously this is more sponsor friendly because they get, promoted, or they get to participate in the profits, right from the beginning, all through the whole period, as well as in the back end. Now, that said, all the deals that I personally invested in and all the deals that we partner, it's all been the former, right? Where there's always a pref, and then there's a waterfall that splits the profits, in a certain way. I've started seeing some deals where, you don't see a pref and you see the split. Doesn't necessarily mean one is good or bad. You just want to make sure that you understand that there are two models and what kind of a deal are you getting into. And lastly, this is some information that some of the sponsors provide. Not everybody provides this, but if they don't, this is something that you might want to look at. As in every project, things don't necessarily go according to plan, as always. So a lot of the good sponsor teams, they would stress the outcome, right? These projections of these return projections based on varying assumptions. And these are a couple of the examples, right? So on the top, you would see in the middle in the yellow, you would see 13.75%. This is based on the current model, right? Based on whatever their growth projections were for the income as well as the exit cap rate of 4.8. So they will run a lot of simulations to see what happens if my net income growth is 2% less than what I projected, or 4% less, or 6% less, or what if it's more than what I projected? And same thing on the left side, you will see what if the exit cap rates are higher than what I projected, maybe 5.05 or 5.3%, and you can see the corresponding change in your returns, which is the center of the matrix. So you can kind of see worst case scenario, like hey, what would you make on this deal if your cap rate goes up, or if your income goes down, compared to what the projections are. The other factor that people tend to do stress test on is vacancy factor. Again, vacancy is a key factor in projecting income. And here, if the deal was projected at 6% vacancy factor and a 4.8 cap, your return would be 13.75. So we want to see what happens if the vacancy goes up to 7% or 8%, or if the exit cap rate were to go higher, or if the exit cap rate, there's a cap rate compression, right? And if the exit cap rate goes on to 4.5, your potential return would be much higher than what was projected. So you kind of want to see this, this is the key piece of information. Not everybody does this, but I think a lot of the, better sponsors tend to include this. You definitely want to see, how your returns are stress tested against lots of different variables, and there are a few other variables that people test on. And that would be the end of this. Just, a couple of follow-on action items. If you like to, have a further conversation, with me, you can schedule an intro call at this Calendly link that I've got there. You can go there and just schedule any available time for a short 15-minute call. And then, after that call, you can join our private investor club, to access, future deals. Again, as you can imagine, like an ICC has regulations on, who can participate in these deals, whether you're a sophisticated and accredited investor. So we have to have that, initial call to make sure that, you fall in one of those, criteria before we can add you to a list. So these are a couple of things you could do. And thank you for listening. And here's my contact information. And sorry for going over time. And Andy, back to you.
That was great. Thank you, Mano. This has been a very in-depth presentation, so I appreciate that. I got a couple questions here for you.
Okay.
Kathy asked, where do you get your sub-market details from?
So again, I think the one that I showed you there is from a site called apartmentinsights.com. Now that may be a paid service that I actually got from one of my listing brokers. So like I said, most of the data that I showed is public information for free. Sub-market information may not necessarily be something that you might be able to find on your own.
Gotcha. Okay. I have a few other questions that I've written down.
Okay. Hey, Andy, just real quick. It's 5:20. I know, we're way past time. Do we want to keep going? Do we want to?
Well, let me
gather these questions, and I can, respond back, in a FAQ doc along with the slides.
Let me just put it out to the group. Does anybody have any questions that you want to ask Mano directly?
Hi. Hi there. Can you hear me?
Yeah.
Yes.
Yeah.
Yeah. Hi, Mano. This is Flags. I know you said you are focusing on multifamily and triple net industrial deals too. Could you talk about the industrial triple net and the ROI and how it works comparatively to standalone Wendy's and Walgreens?
I would definitely love to, but that would definitely be a separate conversation. I would probably want to talk to you, maybe direct, because again, that's a whole different animal, from multifam. There are some similar concepts that kind of carries over, but I would definitely love to talk to you. But
sure,
that would probably take a little longer to kind of explain, how that works.
I got it. Okay, thanks.
Any other questions off the bat?
Yes, can you hear me?
Yes, Marcus, go ahead.
Excellent. Earlier in his slides, you were talking about core plus, etc. And at the bottom of each of those sections, you were talking about that like 60% or 70%, depending on which slot you were referring to. My question is, when you were talking about debt at the bottom of that slide, is that loan to value, or is that just what does that mean by debt on that particular slide, please?
Yeah, so that's just a rough, framework of the LTV across these different, risk profiles. There is no clear definition of, what a core versus a core plus, depending on, who you talk to or, which site you go look at. There are some gray areas. So yeah, so that's just a rough framework of what the LTV, range falls into.
Thank you.
You're welcome.
Any other questions? Good deal. Well, Mano, thank you so much. We appreciate all your insights. It's been a fantastic time with you today. And yeah, please reach out to Mano, myself, if you have any questions, and we can get those answered for you. And let's stay connected. This meetup will be happening every 4th Thursday of every month. So look for that, and I'll have new presenters each month.
And Andy, just real quick, again, thanks everyone for joining the call. Appreciate all the questions. So we'll touch base offline, and we'll get the recording and figure out how to get the slides now. I just want to clean up a couple of things, but we'll definitely send the recording, the slides, and if there are other questions that we haven't answered, we'll send a FAQ along with this.
Very good. All right. Take care, everybody.
All right.
Have a good night. Bye-bye.
Good night.
Bye-bye.
Good night.
Bye, guys.
Bye-bye.